The Hedgeless Horseman here. It's April 29, 2022. In this video I'll touch on opportunity cost and why I think most people misuse that term, and also how I think you could really set yourself up to beat this junior mining sector relatively easy, and that I think most of us do a lot of very unnecessary and costly mistakes simply because we don't have a firm grasp of the obvious. And I'll get to what I mean by that. First off, I would say that there are two things that we can either control or know. Only two. And those are known at any given point in time, and those two things are, in my opinion, the most important factors to always be aware of. Because obviously if you are going to have a winning strategy, a plan, etc., thinking about what you can control and know are obviously the most, or should be the two most useful tools there are. Because if everything was completely random, you would have no idea to even have a strategy if human nature changed all the time. No, human nature doesn't change. It's human nature to change. And those two things are completely different. So the first thing we can know and control is price paid. At any given moment when the market is open, we know what we can buy a company for, what we can buy a share for. Price is what you pay. That's 100% known to everybody at any given point in time. The second thing we know is that sentiment always changes. Sentiment will forever oscillate. That's just how it is. So if you have those two things in mind, just those two things, you've come a long way already. Because I have, spoken to people, and I see comments right now, pretty much. People asking me, will it ever change? Will sentiment ever change? I mean, that is quite a ridiculous question, really, because history shows that it always changes. So that's has been one of the most proven constants, let's say, since the dawn of time, that emotions change. So I don't think that's even up for debate, and as such should always be seen as an absolute. And that might sound like a simple thing, but when you actually understand what that entails, it becomes very powerful, and it brings a lot, in my opinion, comfort, and should bring confidence. Just knowing that, not even debating it, never letting that thought monster creep in that you actually think, which is typical at bottoms, that it will never go up, and at tops you think it will never go down. So let's dig into it. This is a new graph I made. I'm basically adding on stuff from my previous video I did. Let's first talk a bit about opportunity cost. How it is used on Twitter, and I had a debate with a really nice guy yesterday on Twitter about it, is that most people look at opportunity cost as, okay, if we're here now, they're looking at this past period and say there was huge opportunity cost being in miners for the obvious reason that miners went down in price. But that is a completely worthless thing to know. Because in the present moment, I mean, if you use this chart, yes, you should figure out that, okay, the opportunity when we're at a sentiment high is probably not that great, because as we know, sentiment always oscillates. So we're at the high, the projected future is pretty grim, and in contrast, at sentiment lows, the future is pretty bright. Because again, if the glass is pretty much full, the only real change is that it can become more empty. And if it's almost empty, the only really big change is that it can become full again. But anyway, more to the point, the past, you can't just, the opportunities exist at any given point in time. You can't look back at a period and conclude that there, you did a mistake or whatever because price was down. Except if you actually do have a strategy and you simply didn't follow it. So in this case, if you're trading this as a trading sardine, if you're actually just trading Bear Creek mining from a sentiment perspective, yes, you did a mistake because the opportunity was obviously a lot pretty bad up here. But people typically just look at the results and then they make judgment on the action, the previous action. And at the same time, forgetting pretty much that at any point in time, the opportunities change. At any point in time, you can buy, 10,000 different stocks at 10,000 different valuations. So the opportunity set always changes, because we can play whatever hand we want at any given point in time. And we have three options. We can hold a stock if we own it, we can sell a stock if we own it, we can buy more stock if we have money. That's only three options we have at any given point in time. And the opportunities constantly change. We can't just simply look back and see what has happened and then make any form of judgment that, okay, I did a bad call, or we were stupid to be in, or I was stupid to buy this or that or sell this or that, because we're looking at what happened. But the thing is, we have no idea really what's gonna happen. And furthermore, it depends on time frame. I mean, consider this. Let's say you bought Bear Creek Mining here. Then it goes down here. And you're gonna say, yeah, I made a stupid decision to buy here. And hold for every day, 100 days straight, let's say. Because again, that's a constant decision. Because at any point in time you can sell, buy or hold. Sell, buy or hold. Every minute of every day you can buy, sell or hold. So you can make or act on decisions, make decisions and act on it at any given point in time. So since we don't know the future, I mean, if you bought here, went down here, people are going to complain and think they made a mistake. And typically they project past into the future and expect it to go down. And then let's say they make a buy decision here, hold, sell. And then it goes up here. Okay? So what happened during this time? This was a bad buy only if you made a poor decision later. If you didn't sell but held, you would end up here in due time. So that's why I've written here. Winning is an active process and is always in the present moment. Winning is not looking at the results and judging that, okay, I made a good decision, or winning is about having a winning strategy and sticking to that strategy all the time, 24/7. Every minute of every day you have a strategy in mind and you follow it. You can't switch from being, you can't make buy decisions based on, let's say, value, and then all of a sudden you become a trader. Those two buys and sell points don't match, really. I mean, you can combine a lot of stuff, obviously, but it's like you can't all of a sudden change your game plan strategy, because then you have no game plan or strategy. You must have a coherent strategy and follow it through, no matter how much time it takes, etc. And that's also on that point. That's why, I mean, theory is so important, because theory, since we don't know the future, we have to make certain assumptions of what's the rational thing to do. And the past can teach us about what should work in the future. But other than that, the only useful thing about the past is to learn and try to make better assumptions of the future. Thinking of opportunity cost, like at any given point looking what your results are in hindsight, that's absolutely worthless. Except for but if you learn from your mistakes. Because again, a buy here will look completely different depending on what you do afterwards. If you bought here and sold here, that's obviously, you have a positive trade. If you buy here, sell here, you sold at a loss. If you bought here, held all the way through here, and sold here, you would be seeing a small profit. So I guess what I'm saying is that the opportunities are always in the present, and opportunity cost is not taking an arbitrary time period and say, I made a bad decision or good decision. No, you should judge your decision, let's say, on how good the opportunity actually was at any given point in time. Because since the opportunity changes all the time, price levels changes, you have to make informed decisions. Should I buy, should I sell, or should I hold? Should I buy, should I sell, or should I hold? So you have to make the right decision constantly, every minute of every day. Because again, you let's say you're a value investor, or pretend to be. So you thought it was cheap here and bought. Then it went down in price, down in price, down in price, and then all of a sudden you sold. So you didn't play your strategy through, because it was obviously cheaper here than up here. I mean, typically we know that things can change for a company, but I'm just assuming, all else equal. So in that case, you change strategy mid-cycle. And you all of a sudden became a, momentum trader, or probably you're just, a scaredy cat, a weak hand. No, if you buy based on value, if you have a value investing strategy, you have to play the hand through. You have to refuse to sell until you think it's actually overvalued. Otherwise, there's no point. You can't buy for one reason and sell for a totally different reason. That doesn't really work. You're gonna just mess up things up, because you don't even have a strategy. So okay, again, two knowns: price is what you pay, sentiment always changes. So if we assume sentiment always changes, that means that Bear Creek Mining, in this example, this is just a proxy for, don't think of this as just exactly Bear Creek Mining. I'm thinking, sector valuation, junior sector valuation here, sentiment. If we know it's gonna change, that it goes from high to low to high to low to high to low, we have no idea how long time it takes. We have no what path it takes. I mean, here it went down here, but then all the way back and even below before just ramming higher, basically. So that we don't know. We don't know the time. We don't know the actual shape, but we know what's gonna happen. So think about how powerful just that knowledge is. When people are already and typically start to think that it will never go up. And let's look at the actual opportunity cost and what opportunity is. Instead of like most people use it, they make some assumptions of the past, what happened, and make assumptions if you know it was good or bad. I mean, that's akin basically to saying, I mean, in poker, for example, if you play aces 100 times in a row, which is obviously a winning strategy because there's no hand that has an edge on aces, if you lose 100 times in a row, or any time you lose, some people will say that it was a bad decision just because you lost a particular hand. But how does that help you? Are you not going to play aces next time because you look back and saw that, quote, opportunity cost was losing when you played aces? No. That's obviously a winning strategy to play aces, and in the long run that's going to pay off hugely. And the ones that you play aces against are going to lose. So we don't know the future. Investing is like Schrodinger's cat. We have no idea what is actually going to happen in the future. All we can do is try to estimate and guesstimate the opportunities presented to us at any given point in time. At this point in time, we can play 1,000 different hands, which is 1,000 different stocks, and we can buy, sell, or hold. Buy, sell, or hold. 3 options, depending on if we actually own it already, across 10,000 different hands. We just have to fine-tune and have a coherent strategy, which means that over the long term, on average, we will have set us up for success. We will hopefully have had made decisions that are on average profitable in the long run. And again, that goes for you can make a good decision of buying here, for example. That's it's, we know it's going to go here, you buy. Okay, great. You factor in, or that this is cheap, and again, then you can still mess this up by holding, and then you sell. So you messed it up. Great decision here. Great decisions holding, because it's gonna go up here. But then you make one bad decision, which is sell. And that, might cost you an incredible amount. So basically you were winning every time, every minute of every day you made the correct decision, which was, if you didn't have any dry powder, let's say, you bought and then you made the decision to hold for every minute of every second, and then you sold out. Then you didn't actually follow through the game plan. So a good decision here and good decisions all the way down here preceded a bad decision here, and that cost you everything, let's say, because you cemented a loss, and then you didn't find anything that was even cheaper, for example. So that's what I mean by winning is an active process, and that's why I've been tweeting that if Mr. Market can get you to sell cheap, you lost. And why, I remember doing a quote like, the patient hodler is at constant war within. And what I mean by that is that at any given point in time, we can make the wrong decision. So we have to actually, every minute of every day, stick to our strategy. Because any minute of every day, we have 3 different options. And depending on valuation, if you're a value investor, these options increase or decrease in terms of being optimal. So as price goes down, for example, and time goes on, holding and buying increases in being the optimal choice. But what a lot of people do obviously is let's say they hold out here, but then they sell out. Okay, they made a mistake. The even worse things, the the worst mistake you can do is hold on for a long time, and as it gets cheaper, and then sell. Those are the costliest mistake over the last 10 years in Bear Creek mining was selling here. Nothing rivals this decision in terms of costliness. That's costlier, and again, depending on what you do, you could have bought here and sold here, for example. So you grabbed onto the absolutely best opportunity in the last 10 years in this stock, let's say. Granted that this was an opportunity to begin with, because again, we just see what happened. Obviously here you didn't know it was going to go this way. But I'm talking from a sentiment perspective for the junior sector overall. So think of this as the junior sector you're buying. Buying here was the best buy you could ever make. But you could still screw that up if you sold here, for example. I mean, sure, you're in the green, but you missed all this. And we know that if this is the worst sentiment ever, if the glass is 99% empty, if you sell when it's 96% empty, that's not really taking advantage of sentiment, how that works, how that swings. No, we want to buy, preferably buy when glass is empty and wait till it's closer to full. So this is just, if you sold after, you made a great decision here, then a poor decision right after. And you lost out. Okay, let's think about long-term compounding. And in light of game theory from a cyclicality perspective. If we know that sentiment always changes, we know the junior sector is going to hit this sentiment level at some point in the future. We know, take that to the bank, we know that is going to be true. What does that also mean? That every additional down day, we don't know if we're in a bull or a bear, let's say, but what we know is that for every passing day we have left a sentiment high, it gets closer and closer and closer to the next sentiment high. And in the middle or in between we will have a sentiment bottom, or even two. So, okay, what do we know? We know that sentiment always changes, and we know we're going to get up here. We don't know when we're going to get up here, but we know we're going to get there. So, what would be the two most important factors to have the most obscene compounding you could have? First of all, price, buying as low as possible, as cheap as possible, as far away from the sentiment high as possible, which would be at this point. Okay, what's the second thing? Obviously, the sooner you can get returns, the better, the quicker the compound. And just to show that, here for example, let's say it takes about a year to reach this level. Okay, wait, okay, I messed that up actually. Yeah, that should be, this is just me being stupid. This should of course be 200%. Okay, brain fart. If we don't know this, of course, but there is a possible future where we hit this sentiment high in 1 year. And that would bring 200% return. That's a compounded annual growth rate of 200%. That is insane. That's an insane return. Okay? But what if it takes 2 years? I'm just going to check there. Yeah, that's right. If it takes 2 years, that's a 73% compound annual growth rate. That is obscene. If it takes 3 years to reach this level, that's an annual compound of 44% per year from this level, this price level, and this point in time, right here where we are. And okay, how do you steepen this? Or let's say, I'm just going to show why. Again, winning is an active process, and it's always in the present moment. Okay, what can happen if, how does this get steeper? Obviously, the shorter period of time it takes to reach this line here steepens. If we would go 200% tomorrow, that would be a compounded annual growth rate of, I don't know, thousands of percent. But if it takes a year, it will be this steep. If it takes 2 years, it will be this steep with a compound rate of 73. If it takes 3 years, 44%. Okay. So, and obviously, okay, so we know time steepens. The shorter the time, the better. Like you can see here. Returns, obviously, price level is good. If we start from down here, this is steepening, so we have even higher compounding. If it's shorter in time, as you see here, I mean, the longer it takes, the worse compounding. So price level steepens it, and time steepens it. Okay, and what else do we know? That if the only thing we can know is that it will hit this level. And since we know that the longer it takes to reach that level, the closer we are to reach that level. So what I mean by that is, as this drags on, we get closer and closer and closer to it, and it doesn't matter if it's in 3 years or 2 years. For every passing day going forward, this is just steepening, 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 regardless of when the actual high will come. Because the only thing we know is that it will come. And if we know it will come, that means for every passing day that we are not there, this steepens. And if we have, let's say, a fixed price, you see this steepening. But if it goes up in price, it does the opposite effect, obviously. So the opportunity decreases a bit by price going higher. Because yes, we will reach this level at some point in time, but the gains from where we are at that present moment will be a bit less. So as price goes up, opportunity goes down, or future expected returns go down. But if actually it takes 3 years, but we have a price down here in August, for example, that means that the opportunity here is even better, or obviously better than here. Why? Because one, we start from a lower price, so our future expected returns will be higher. Two, we have gone ahead a few months in time, so we're closer to said high. And what does that mean? That means that, again, like here, holding and buying increases in value, constantly increases in value. So even if this price action here was fixed, that price just stay down, stay down, stay down, stay down. No matter when the high will come, the opportunity just gets better and better and better and better, meaning that selling just goes up in cost, in future cost. That's opportunity cost. It goes up and up and up in cost, because obviously as time passes, we get closer and closer to this high, and we don't know when it will come. It might stay flat all the way here, and then just, let's say it just suddenly jumps. Okay, when would the best time to buy or hold be in that case? Obviously here. And the second best time to buy or hold would be here. and so on and so forth, all the way back here. So again, this is a concept I think is very important to understand, that if we know we will hit this level, every passing day we stay at this level here, holding becomes better than selling, and buying becomes better than selling, obviously better than selling and better than holding. Because if you buy here, that's better than buying here because we've churned some time in between. Again, regardless of when the actual high is going to come, this line here, expected rate of return, is steepening. And buying becomes even better and better. So that this is what I think most people really don't understand. That the longer this correction continues, the costlier it is to sell. It just increases in cost, no matter, regardless if we know when we're gonna hit the sentiment high. That's the main thing. So I mean, if you just understand these points, think of the implications. Most people have absolutely no clue about this. Some people ask if sentiment is ever gonna change. That makes no sense. We know that sentiment will change because it always does. So I might need to redo this video because there's so many points I want to get across. But just keep this in mind. If there's anything you take away from this video, is that day one after a sentiment high is put, we get closer to the next one. And in the meantime, we'll have a sentiment low. And up here, for example, buying, especially in a trading sardine, this is the worst time in this short to buy. This is the best time. Okay, why was this time the best? Not only was it due to price, but it was because, the longer it took, the closer we obviously were to getting to a sentiment high. Again, if this sentiment high came here, this would still be probably the best time to buy. It would at least be better than all the previous buys because time had passed, and in this case price had declined. But even if let's say price went like this, just flatlined, and the sentiment high came in here, this would obviously be a better buy than here because we've churned even more time and gotten X amount of months closer to the inevitable sentiment high. Then there are scenarios where, we go ahead in time and price goes up. Okay, so opportunity versus from a return perspective, because there's a lower delta to go from here up here than from here up here. But at the same time, we have actually churn time. So these returns from here to there will come quicker than from here to there. So again, it's like the absolutely best case scenario, the best buys are when the most amount of time has passed from the previous sentiment high, and price has gone down as well. So in these three scenarios, for example, if time passes and price goes down here, the cost of selling increases a lot because we've churned more time and the expected future returns are even higher. And since it's a multiplier effect, this becomes obscenely costly of selling. And of course, by holding increases in value because the the opposite of holding is selling, and selling is going exponential. So holding becomes exponentially important, as well as buying. But then if price goes up, the cost of selling decreases, because whenever the next high is going to come, this rate of return here is flattening out. But at least we will have churned some time. But we will have had some gains in the meantime from this point here. So I guess also what I'm trying to show is that opportunity always changes, and we have no idea about the future. The past doesn't matter at all. The past doesn't matter at all. What matters is the future and the fact that sentiment swings. And the longer something takes to get to a sentiment high, the better the buying opportunity is. Because, again, I was going to keep on hammering this home. Since we know sentiment will change, we know we will reach this level. It's just a matter of when. And from this level, you could wait many years, and that would still be very, very profitable. And if you could buy during all this time, even if this flatline, for example, if you bought here, great, expected returns 200%, and in less of a time frame than here, so a buy here will be better than a buy here. A buy here will be even better, because that's 200% in even a shorter time frame. And here will be better than buying here, 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 and here, or here. For the simple reason that you will get a 200%, but in an even shorter time frame, so the compounding goes up even more. And obviously, holding becomes extremely important because the option is selling, so you're giving away said insane compound results. And obviously selling, if we flatline for like, I don't know, 2 years or whatever, selling here would be the costliest mistake you could ever make, because this was very imminent to the next sentiment high. So this is the whole reason why I'm not worried at all, why I'm buying like a scolded cat, basically. Because I know this is inevitable, and the question is simply when. And in the meantime, I'm trying to pay as low of a price as possible, and selling is out of the question, because regardless of when it comes, the expected returns and expected compounding rate is just going up for every passing day. This shit show continues. I hope this all makes sense. It makes a lot of sense to me. And again, I mean, you sow down here, you harvest up here. So and regardless of when the actual harvest comes, the better the buying opportunity is, the cheaper you pay, price the thing you can control, and the more time passes, because inevitably we get closer to the next sentiment high. And again, regardless of when that is, it gets steeper and steeper as time passes. If price stays the same, it gets steeper if price goes down and time passes. As price goes up, that's a bit lower future expected returns, but at the same time, if we're far away from a high, we're at least closer in time to said results. But then it can go down again, and then it just becomes better. So take this for example. Let's say the top will be in 2 years. Here you have a pretty steep and relatively short, I mean obscene compounding. Up here, the opportunity got a bit worse, and then it went down again. So most people are frustrated by this, obviously. They tend to buy here when it goes up because they think now the bull is on and we're gonna go like this, and then they get pissed again when it goes down. But obviously, from a compounding perspective, you would be very happy to have price sit at these levels for a long time still, because every additional purchase here will have 200% expected returns, and the more time passes, the shorter the time frame it takes to get those returns. And again, the returns here, even if it continues, people think that they made a bad buy because they bought here and price just flatlines. And then you'll hear about opportunity cost. No, that's not a big opportunity cost. Because as long as you don't F it up by selling, you're gonna get the returns you were gonna get. The only thing to mess up this and actually have it become, let's say, opportunity cost is that you made a good decision of buying here, but selling here. That's how you turn this good buy into a mistake. Basically, you stop the process of winning, because winning is sticking to a plan and doing the optimal thing at any single point in time, any minute of every day. So you can make the optimal decisions all the way down here and then mess it up. You could have bought here and, let's say, made a mistake, but you let's say sold and found a better place to be. And it doesn't matter where you've been. If you made a mistake, let's say, of you started buying up here, it doesn't make it better if you start doing mistakes down here when mistakes are going exponential in cost. Meaning selling is going exponential, because the expected future compounding is going exponential as time goes by and, let's say, price goes down. So why am I, some people might find me arrogant or cocky, etc. Well, I see it as confidence, because I know what I'm doing. I have a game plan. And every time I can stick to my game plan in this irrational, sentiment-driven market, I am winning. And I'm winning every day I refuse to sell. I'm winning every day I buy. So I'm winning every day, and it's a process. But I can be let's say, a loser, because if I bought and held and then sold here, yeah, okay. And who knows what I did with the money? Found an even worse, opportunity or sector, let's say. That's how you lose. So in order to winning is not buying and then selling at a profit. Winning is what you do every day. Every day, all decisions you make is winning. You can't win one day and lose the next day. Then you're not a winner. But of course, you don't need to be a perfectionist. It's just that if you want to have the best possible returns, you have to win every day. You have to make the right decision of the three options: buying, selling, or holding. And you have to keep that up as long as you invest. In your whole investing career, you have to keep that up all the time, because a good, let's say, a good buy can turn into a, quote, bad buy if you sell here. But this would have been a good buy if you sold here. Everything is depending on, nothing is fixed. You can mess up a good buy easily. You can fix a bad buy by, let's say, selling early. Right now, we're way past the point of selling, and the cost of selling is going exponential as time passes. I hope you got something out of that. Maybe I should redo this video actually at a later stage. Thanks for listening. Bye.